Hi, I'm Brad Case, Homes.com's chief residential economist, with one thing you should know about the homes market. This week it's bank lending standards. The Federal Reserve surveys big banks every quarter to find out whether they're changing their standards to make it harder or easier for borrowers to qualify for loans. This week's results included two that I thought were especially useful for home buyers. First, most banks said that they were tightening their standards for mortgage borrowers with credit scores less than about 650. That means for those borrowers who are stretched financially or who have poor payment histories, they're likely to find it harder to qualify for a mortgage. But most banks said that for borrowers with credit scores higher than that threshold, they're easing their standards and those borrowers should find it easier to qualify for a mortgage. The second result that came out this week was that most banks said that they expected the demand for residential real estate loans to increase during 2026. That's typically because banks think there will be more mortgage borrowers, either because interest rates are going down or because there are going to be more home buyers for other reasons. So if you're thinking about buying a home and you've taken pretty good care of your credit history, it sounds as though banks are going to be looking forward to working with you. If you're thinking about applying for a mortgage, here's a tip. Before you do so, make a few calls to other lenders or mortgage brokers to find out what sort of a mortgage interest rate they're willing to offer you. A study recently found that most borrowers don't do any shopping, but those who do tend to get a lower interest rate by an average of about 11 basis points. That's about $22 a month if you're buying a median-priced home. That's $260 per year for 30 years. Just for shopping around beforehand. I hope that's helpful. For Homes.com, I'm Brad Case.